the course of 2 weeks in March, events put in motion several years beforehand culminated in one of the biggest financial crises seen since the 2008 housing collapse. The end results are still to be seen, but even if the crisis doesn't get any worse, billions of dollars were lost in the process. So what, or who, is responsible? And what comes next?
Let me get into the first, Silvergate Capital. As you can see, shares are down another 20% today, as it says it'll shut down amid the rout in crypto and followed at some of its highest profile customers.
Silvergate Bank was one of the most crypto-friendly banks in the United States. By the third quarter of 2022, it held at least $12 billion in deposits in its Silvergate exchange network, including deposits from all major cryptocurrency exchanges. In late 2022, following the fall of FTX, depositors became concerned due to Silvergate's exposure. Their share price fell 89% from its all-time high posted in November 2021, and by December 2022, Silvergate deposits had fallen to $3.8 billion. On March 2nd, a story broke that Silvergate had notified the SEC that it would be unable to file its annual report on time due to a change in their capital position and a pending investigation from the U.S. Department of Justice. Their shares fell a further 45%, and customers began rushing to pull their deposits. This forced Silvergate to sell assets to cover their withdrawals, taking a loss on the sales of $718 million. A few days later, on March 8th, Silvergate Bank announced that it would voluntarily wind down its operations and liquidate. At the time seen as a unique situation caused by a mix of the fall of FTX and bad management, this was only the beginning. On the same day as Silvergate's collapse, March 8th, several factors were set in motion at Silicon Valley Bank, which would eventually lead to their downfall less than 48 hours later. But the foundation of these mistakes was set in the preceding years and months. In 2015, Greg Becker, the president of SVB, appeared before Congress to argue that increased regulations put in place as a result of the 2008 financial crisis should not affect his bank, due to the, quote, low risk profile of our activities. After 3 years and over $500,000 in lobbying, Congress agreed. These new regulations would exempt banks like SVB from publicly reporting the results of a company-run stress test and reduce the minimum frequency of liquidity stress tests, the kind of stress tests that could have saved the bank years later.
You've just had your own numbers. You are, of course, a company that, about roughly 50% of the venture capital companies out there in the US, many VC firms, bank with you. You had a record year. Is that likely to continue?
In 2021, as the Fed printed money and lowered interest rates to unprecedented levels, venture capital companies and startups found funding easy to come by. Once they made that money, they needed somewhere to put it, and around 50% of the startups in the country chose SVB for this purpose. SVB took in tens of billions of dollars, increasing their total deposits to $189 billion in 2021, making it their best year ever. They used some of that money to give out loans, and they put some of it into securities. Confident that interest rates would stay low, they invested in longer-term bonds, expecting their value to slowly and steadily grow. In 2022, as the Fed began aggressively hiking interest rates, the value of the long-term bonds SVB had invested in started to go down. This isn't necessarily a problem. The bank could hold on to the bonds until they mature and sustain no losses. It would only be an issue if the bank suddenly found itself in need of liquidity. In early March 2023, SVB met with Moody's Investor Service, who informed them that the bank's unrealized losses put it at a serious risk of a credit downgrade of at least one level. This puts Silicon Valley Bank in a difficult position. Either sell a large portion of their bond investments at a huge loss to increase their liquidity, a move that could scare off depositors and cause a bank run, or stand pat and potentially receive a multi-level credit downgrade, perhaps having the same result. In the end, they decided to sell their bonds and announced their intent to raise $2.25 billion by selling new and preferred shares, a move they were hoping would calm depositors. It did not. The bank began hemorrhaging deposits as their clients lost confidence, and a number of prominent venture capital firms advised their portfolio companies to pull money out of the bank just in case. On March 10th, their stock had fallen over 60%, and the FDIC took the bank into receivership, marking the second largest bank collapse in U.S. history. The FDIC announced it would insure all customer deposits, but the following day, another announcement sent out huge ripples across the cryptocurrency space.
and there will be a catastrophic. This is a national security issue because this is a lot bigger. This will splash across all of the economy.
Circle, the US firm that backs the stablecoin USDC, announced that 3.3 of its $40 billion USDC reserve was housed in Silicon Valley Bank. This caused USDC to depeg from the US dollar for the first time in history, trading briefly at 88 cents before finishing the day at 90 cents. The consistency of stablecoins is part of what makes business in crypto possible. While even large coins like Bitcoin and Ethereum are extremely volatile, stablecoins make it possible to securely and consistently send and receive payment over crypto. Stablecoins depegging will have long-term ramifications on the legitimacy and predictability of crypto. Just one day later, Janet Yellen, the US Treasury Secretary, announced that they would not bail out Silicon Valley Bank, saying that despite the bank's collapse, she believes the US banking system to be, quote, really safe and well capitalized and resilient. Well, later that same day, the New York State Department of Financial Services closed Signature Bank. The FDIC was appointed receiver, marking the third largest banking collapse in US history. Signature Bank was another of the most crypto-friendly banks in the US, helping to host tools that facilitate digital transactions and boasting companies such as Coinbase as their clients. The collapse of these two institutions, Silvergate and Signature Bank, is a huge blow to the crypto industry. Both of these banks helped lend legitimacy to crypto companies and provide key services to clients. This is almost certainly not the end for crypto-friendly banks. Federal regulators are likely to continue looking closely at any bank with large crypto holdings or services, while financial institutions are likely to move even farther away from dealing with cryptocurrency than they already were. The following day, HSBC bought the UK arm of Silicon Valley Bank for £1, excluding the assets and liabilities of SVB, UK's parent company.
The arrangement that we facilitated between the Silicon Valley Bank UK and HSBC allows that. Customers can be certain they've got access to their banking facilities again. It's good for HSBC, which is a successful British bank, and as a result, it's good for the economy. That this wasn't a systemic issue. We've now resolved this bank. We've resolved that decisively.
Your business update now. Credit Suisse shares hit an all-time low, plunging around 25%, triggering several trading halts along the way. Now, the decline.
On March 15th, the Saudi National Bank was asked if they would be open to further cash injections into Credit Suisse Group, the second largest Swiss bank. Their response? Absolutely not. Those two words caused Credit Suisse's stock to lose more than 25% of its value, falling to record lows before the Swiss market put an automatic pause on their shares. Interestingly, this has been the Saudi National Bank's stance on Credit Suisse since October, as even if they wanted to put in further investments, it would open them up to regulatory issues they wish to avoid. The panic sales of Credit Suisse stock was almost certainly influenced by the continued disquiet over the banking turmoil of the previous few days. While Credit Suisse has been marred by problems for years, including bad bets on hedge funds, a spying scandal, and repeated changes in top management, it held over $500 billion in assets. Their collapse perhaps presents the power of panicked consumers and the ripples that SVB continues to have around the world. It's difficult to see the near or total collapse of 4 banks across the world in 2 weeks as a series of idiosyncratic cases, as government officials and regulators attempt to soothe the public by stating each collapse had its own well-documented reasons and the banking system as a whole is safe. The wide-ranging effects of the downfall of Silicon Valley Bank are yet to be seen. The decreased regulations that allowed SVB to make such poor investments and overextend itself have not changed. The uncertainty surrounding USDC, the second largest stablecoin, has major implications for cryptocurrency, not to mention the loss of legitimacy sustained from 2 of the biggest crypto-friendly banks in the world disappearing overnight. Some of the largest crypto exchanges in the world briefly stopped trading USDC, and while it has now repegged and things seem to be back to normal, has people's trust in stablecoins been irrevocably damaged? And maybe most importantly, consumers are still afraid, perhaps more so with each passing day as each new piece of bad news comes out. Any worrisome indication from the banking industry could trigger a bank run or the selling of shares. How many banks are well positioned to handle large consumer withdrawals? And how many are on the brink of collapse without the public knowing? Is this the end of the crisis? Did 4 unique, disconnected events happen over 2 weeks in March, losing billions of dollars? Or is this the beginning of a collapse, the likes we haven't seen since 2008. Only time will tell.